Hey, welcome to Exchange. Let's talk about this inflation real fast. CPI numbers came out today, which is actually really interesting though too, because you saw this massive increase, basically in energy prices in the last 30 days or so, 15 to 30 days, and really seeing it in the CPI print. And it's actually not as bad as I thought it would be. I think well, so they're saying overall CPI, which is basically inflation year over year. 7.9%, which I highlighted right there. But really, in actuality, if they took numbers like, I guess over the last 2 weeks and so, including March, it's probably about 9 to 9.5%, with oil sitting about 105 to 110. So the thing about CPI is for every $10 of oil increase, you have about 0.1% of overall direct energy increases and about 0.4% of basically follow-on cost of goods. So basically, your cost structure of companies like transportation, the cost of products and services, it's affected by energy as well too. So that's where that 0.4% comes in. So it's definitely a volatile overall number right here, but really see right here is the energy column. This is for February. This is month over month. You're seeing these 6s, 7% up, overall. The actual electricity itself is actually down 1% from January to February. Pipe gas, obviously natural gas is up there too. So that's really the bad numbers. Food itself is pretty bad, but look at this. Food away from home is interesting. The last 4, 5, 6 months, it's actually decreasing. I mean, we might be at the point now people are running out of cash, we're running out of potential, work from home culture might be shifting potentially. But you're starting to see kind of that away from home food actually drop, which is interesting. This might go potentially to zero in by April timeframe, which would be a kind of a shock right here. Obviously, energy prices and everything else too with food. You're seeing the inflation kind of pick up again on the actual at home food right there. Another interesting thing to look at here is new vehicles. So new vehicles as a whole is pretty flat, from January and February. Obviously, a big, steady upticks all throughout last fall. Interesting part here, though, we actually use cars here actually go negative. So it's at negative 0.2%. Now I confirm that basically this is from Car Gurus. It's basically the same thing. It's almost like a price tracker, a trends tracker. They're seeing the same thing in the last 30 days. Used cars are down, 0.75%. Used cars are up a little bit, but not by much though too. So actually, we might be the top of the market right now for used cars. New cars are going to keep accelerating maybe a little bit longer just because there's a big supply-demand imbalance where supply is pretty low, demand's pretty high. But used cars are reaching that point where, hey, maybe we're getting saturation right there. Maybe the used cars are at the point where, hey, people aren't willing to pay those prices well above normal used car prices. And also, too, as used cars drop down, new cars will follow it eventually. It's going to happen. This whole idea of $80,000 trucks, $90,000 trucks, etc. It's not going to be sustainable because people are A, running out of cash, and B, psychology is shifting right now. We're starting to go, at least in used cars, new cars, into a slightly deflationary kind of mindset where people are like, hey, if I can wait 6 months potentially, I can get a much, much cheaper vehicle, maybe save $10,000 to $15,000 for those higher end vehicles. So that'll be interesting to look at that going forward. Another thing looking at here too, this is actually looking at apparel. So apparel really spiked, December, January timeframe, really around that Q4 kind of holiday retail sales. It's been pretty flat in February, and this is one of those numbers where you're looking at here potentially in March, April timeframe. It might go to 0.1, 0.2%, or it might go to zero potentially. It could have apparel basically deflation. But you look at it here too with a inflationary environment right now, people buying new clothes, new everything potentially for their wardrobe. It's just not much demand right there, and that's going to basically affect all of your apparel companies out there. So this is one of those things where, hey, late spring, early summer time frame, those sales might potentially happen just because they want to clear out certain inventory. The actual backlog of goods might catch up potentially in the next few months for the apparel category. Obviously, medical care, it's all over the place. This month was 0.3%, not much to really see there. Shelter is pretty flat. It's been roughly 0.5%, 0.4, 0.5% in the last few months. No real change there. Transportation services, this is driven by energy costs. Obviously, they're seeing that increase over time. It's basically a cost to move goods around the country, whether it's rail, trucks, or just personal transportation. So it's pretty high there. And then medical care services, obviously, is decreasing. But it's not a huge expense for most Americans unless you're older or potentially have basically existing conditions where you have to deal with in life right now. But yeah, overall, it's not a bad print. The market itself sold off a little bit, but not by much. March, though, is going to be much, or basically the April release for March data is going to be much more interesting because this Ukraine crisis, whatever happens with that, it's going to be a massive increase. So, if I had to guess right now for the April print or April release, we're probably going to see about a 9.3, 9.4%. If oil doesn't crash, nothing happens to the Ukraine crisis, if it keeps stagnating on right now, potentially a 9.4, 9.5%. It could be worse though too. We'll see what happens, but it's definitely be a very hot print. And the question is, what does the Fed do with that hot print? Do they let it ride? Do they increase or basically taper in and increase the actual federal funds rate faster than basically 0.25% per meeting, or is it potentially change to 0.5%? That's a really big question. And if you answer that question, you're basically a stock market guru at that point. You know the entire answers to life. Hey, let me know your thoughts on this one too. This is a very complex one, so if you think it's transitory, definitely let me know. By transitory, I mean 6 months or less right now, or if you think it's hey long term, like as in multi-year inflation, potentially 3, 4, 5% plus. Definitely let me know. If you like the video overall, hit the like button. Obviously, subscribe down below to the channel, and that's the exchange.